we go. Okay, with that we should be live. So hello and welcome to another live stream with me, Christian Rauchenwald, on this, what do we have, Wednesday. Unfortunately, a little bit late. I still needed a couple of seconds to finish the setup of the stream. In the meantime, everybody has time to join in. So as usual, we are today continuing our application of Elliott Wave Theory on different stocks. And as mentioned, I think in yesterday's episode, we are going to actually take a look at GameStop, although as mentioned right now, the Elliott Wave Theory, due to its nature of being based on mass psychology, does not apply as much anymore. That's working okay. So just have to catch up with my to-do list. Okay, we have audio, we are in the right stream. We have that, I'm gonna skip that for now. So I said, welcome everyone. Don't forget, it really would help if you subscribe to the channel, enable notification. It helps me, but it also helps you because you then don't miss out on future episodes. Besides that, you can obviously always use the links in the video description down below or the pinned chat message, for example, to check out my portfolio, to access the same software and tools that I'm using for my application of Elliott Wave Theory. And I'm just finishing up a set. I was on a call with my accountant and therefore got a little bit delayed. So I still have to start up the software that we're using, which by the way is called Motive Wave, and that we use in combination or with Interactive Broker as the data source for Motive Wave. And on top of that, we also use Wave Basis. And on top of Wave Basis, we also use TradingView. And that should then be pretty much it. So I'm going to be ready in a second. So I need to confirm on my phone that we start Interactive Broker. So we have data in TradingView. And then there we go. And Motive Wave, and as usual, I'm gonna switch real quick to the desk cam. So part of our whole strategy / analysis is, as mentioned, Elliott Wave Theory, which again is based on human mass psychology. So it basically relies on human behavior, which means it applies better on indices like the Standard & Poor's or the whatever NASDAQ and so on. And if we label individual stock with Elliott Wave Theory, we might not always get the desired result and or be able to label the things the way we want to label them. Now that's the account here. Okay. And with that, do we have everything in place? So jumping back here to the chat real quick. And by the way, don't forget, there's also a cheat sheet about Elliott Wave Theory down in the description below. So it's a one-page PDF that we reference fairly often throughout the streams. Now, last but not least, the streams are aimed to last pretty much 30 minutes or so. So we'll use a timer for that. And actually, the really last thing before we get started is obviously the disclaimer that you guys can see here. And because everything that I share in this live stream / video, if you watch it later, is my personal opinion and in no way financial or professional advice of any kind. You should always do your own research, consult certified professionals, draw your own conclusions, and make your own decisions. So while I'm sharing what I know and what I think is right and is going to happen, doesn't guarantee that it is. It's just my personal opinion. You always obviously should do your own research and due diligence. Now we're gonna quickly fire up the timer, and reset and start. And with that, we basically have our 30-minute mark going. And with that, we're actually gonna jump to there. And here we are currently looking at wave basis. However, we're gonna circle back to Motive Wave first. Now, if Elliott Wave and everything I'm sharing in this stream seems to look like Chinese to you or just doesn't make sense, so like a foreign language, then you should obviously go ahead and check out episode number 1 first. And you should also use the link in the description either to order a physical copy of Elliott Wave Principle or to use the link and read the book online for free. Now, that said, as mentioned, we said we're going to look at GameStop today. Yeah, we're gonna quickly first verify how our other labelings are doing so far. As mentioned, for the SPX, we expect a turnaround. We would have to adjust that labeling if the price goes higher than 4,195.44. So we still have some wiggle room here. And even then, we wouldn't worry too much as long as we're below 4,325 and even slightly above that, it would still be okay. But ideally, we would actually have a turnaround happening right now, which means basically this week, like the last 2 days have red days, markets going down overall, and we'll see how that turns out. Now for the NDX 100, so for the Nasdaq 100, it's not that clear there. We also have a similar labeling. However, we don't have our 0.2 fixated yet. So although we have similar expectations, which means that we would also expect, actually gonna add a Fibonacci retracement here real quick, and that's gonna go for so bring that down, and that's gonna go from here to here and then extend it. So basically we would be okay with the 50% line is turnaround point, 61.8% is turnaround point. Anything higher we would start to worry a little bit, but not that bad. So we're still in a good shape, although that means that basically we are currently losing money while we're in this upwards trend, because I cannot determine exactly where that point of turnaround will be. And therefore, we are losing a little bit in our portfolio while this is still ongoing. But there should soon be, at least in my opinion, then the turnaround, and we continue the journey downwards. And that would be a third wave movement, which would mean it would be a very strong drop. Hi Akashi, great that you made it. Got a haircut today, managed finally to get one, and everyone wants the cheat sheet. The cheat sheet is a great help, but it saves a lot of time of looking up stuff in the book, but it still requires a good understanding of Elliott Wave Theory to really know what's on the cheat sheet, But so moving on, so then we looked at Shopify, where our prediction is that this is our wave 2. We are not sure yet about that part here, but basically we have our trade open with our stop loss at 23.63, because if we're now in wave 3, it means that over the next couple of years, Shopify should create a new all-time high, which means our risk-reward ratio is great. We have 50% risk from the current price down, whereas we have like a couple 100% just to get here, and a real third wave would actually go further. So we'll see how that turns out. So again, risk-reward is really, really great. And then again, when we talk about 50% risk to a stop loss at what we determined is wave point number 2, only applies to our position size. So since we have 2.6% invested, it means that even if this is wrong, our portfolio will lose 1.3% total. Whereas obviously the same goes if it's right. So if we make a couple 100% return here over the next couple of years, it also only applies to the portion that we've actually invested. Now we keep an eye on this, and once we have a clear development that this is indeed like going the way we want it to, we might increase our position. But yeah, that's that there for now. For BKI, so Black Knight Inc., it looks similar. So our assumption is that we're looking at this, and that basically our downside is, our downside is actually even smaller here. So we have a 10% downside to 52, where on the other hand, our upside is more than 100%. So 96% of the portfolio, whereas our upside is actually 2-3% return. That small position, the 2.6% that we have invested, can bring the portfolio over the next couple of years. And and then we looked at Ford in yesterday's stream, where we are not so sure, which is why we have an incredible big downside potential here. So we have 80% downside or 60-70% downside. So from the current $12.50 to around $4 with our stop loss. While on the other hand, our upside is also incredibly high, because it would mean that we at least, that price here is estimation or so, but we would at least, the upside here is actually not that high compared to the other position, but it's still high enough that we can say, okay, we would have to at least cross the $18 and to even determine, okay, we're definitely in wave 3 and have a breakout from that. And so overall, I would still say we have upside here. But again, we're talking for a couple of years, because as you can see here, that's basically 16 years history that we're looking at. So the movement that we expect to get us here is not going to happen in a week or in a month, but actually over multiple years. or it turns out wrong and we hit our stop loss, and then on this position we have 1% invested. So we, again, even if we hit our stop loss, or 1.3% of our portfolio, so even if we hit our stop loss, we still only look at a loss of like 0.13% or so on the portfolio, where again the upside is much bigger. Now that gets us to the next chart. So as promised, we're going to look at GameStop, which is actually what I did when I started the channel, applying Elliott Wave Theory to GameStop. And back then, we're going to start with a monthly chart. Back then, GameStop was not as much directly registered as it is yet, and so on. Therefore, the mass psychology still applied a little bit more, but since then the stock has been just heavily manipulated. Now, the overall labeling here, and there we refer back to something that I shared, I think yesterday for the first time, is very often when companies go public, the company already exists before it goes public, and then usually you have a lot of hype about the company, and then it's about time to go public, which if we consider an Elliott Wave, so cannot do that in the random air, but if we consider an Elliott Wave pattern, then, and it reflects mass psychology, then the going public would very often be wave 5, yeah? So if we assume that's the end of wave 5, or if wave 5 would have been here before the company goes public, and then we start with a dip, because that's then the correct, for example, like this, although it's a rule violation because our wave 2 terminates beyond the origin, yeah? So because here we go lower than we were here. Although theoretically one could assume that we already have another 1, 2, 3, 4, 5 developing here and so on. So like there are some ways how even the pros at Elliott Wave International would agree to say, okay, we can start with labeling like this. However, that would then give us basically the idea of having a skewed base channel, because our base channel would look downwards if we use Kennedy channeling technique, because if we take our 0.0 and 0.2 and with a parallel through 0.1 and extend it, then we have a base channel that means lower price. So we actually would have to, I don't know, we don't know that whatever virtual value there would have been before they're going public, but we could assume, okay, let's say it was like a straight sideways movement roughly, or slight upwards movement, which would then indicate that we're here in the third wave movement. However, this cannot be wave 3 on that big scale, because it wouldn't fit in terms of, okay, we have 2003 till 2000, what do we have here? 2003 till 2000, bottom corner, 2007. So 4 years here, and then we have basically 14 years till here. And then suddenly we would have less than 1 year with the, in quotes, short squeeze, which was not really a short squeeze, but just organic buying pressure till here. So we'd actually expect that whole wave pattern to last much longer. And we can also actually, let's tie that back here, and to last much longer, in which case we then would have to ask ourselves how to label this. And if we look closer, then we would look at, so on this monthly chart, we would probably do something like 1, I mean, maybe not exactly like this, yeah, so, but that would be our starting point. 3, and then we would have a very, very long wave 4, and then we would currently wait for our wave 5 to develop, which, if we were to use Kennedy channeling technique on this, would be starting point, or actually 0.2, sorry, so the destination channel 0.2, with 0.4, if that is already the end of the corrective pattern, with a parallel proof through 0.3. And then our wave 5 would either touch the median or the top of that channel in the end. Yeah, but again, we don't know when that happens. And in terms of time frames, it's also not super perfect, because all of this here is basically a few months. From here, what do we have here? November 2020 to here, January 21. So we're only having a couple months here, whereas we then have actually years already here. It would somehow fit with the rule of alternation. So if you have a simple wave 2 correction, then you have a drawn out wave 4, or vice versa. So a more complex corrective pattern. But other than that, that's like, not the, how do you say it? Like, doesn't have to apply here, because again, if we base Elliott Wave Theory on, I'm going to circle back to another view here. So if we base Elliott Wave Theory on mass psychology, then obviously a stock that is completely different from most because it has like a huge percentage of shareholders that directly registered their shares, then that throws the whole idea out of the window. Yeah? So also there is still a lot of short positions, a lot of dark pool trading volume and so on. But it's also the case for other stocks. Yeah. But again, the core difference from the things that you can publicly verify is the number of shareholders that directly registered their shares. So there's around 25% of shares are held actually by people like me, regular people in quotes, that have invested in GameStop and have directly registered their shares. Now, usually we would now dive deeper into the Elliott Wave Theory part and so on, but again, I'm done because of how the stock behaves differently from the rest. So the mass psychology aspect doesn't apply anymore that much. So we're going to dive into a little bit of a different topic, and that is like, what the heck is direct registration and so on, yeah? And why am I still holding some shares in my eToro portfolio and whatnot, yeah? Now, when it comes to the stock market, there is this huge that eventually happens, or that epiphany or realization that you actually, at least for the US stock market, I didn't bother so far to look up how it works in the EU, but if you buy a stock, doesn't matter if you buy it on eToro or on Interactive Broker or Fidelity, so you buy shares, and then technically you do not own those shares. So it works in the US in the way that there is a company called CEDA NCO, which is owned by some of the participants of the DTC, which again is part of the DTCC, or vice versa. I'm always getting those confused. So, but you can look it up on Wikipedia. And they are the owner of all publicly traded shares of every company that is like basically in the US. Yeah. Or yeah. And whenever you buy with your broker, what happens is your broker has a database that says, ideally your broker has a database that says, okay, you bought one share of Apple or of GameStop, and he enters that in the database. And at the DTC or DTCC, again, I'm always mixing those up, basically has an entry on their side that says your broker has one share. Yeah. So the DTCC doesn't know, or DTC, again, mixing them up all the time, or confusing them all the time, doesn't know that you hold a share, which means the company also doesn't know. So if you were to fly to your GameStop shareholder meeting because you have a share in your broker, they might not let you in because they don't know that you have a share, because on the book that says, hey, yeah, oh yeah, stream's dropping a little bit, so having some issues here. But yeah, hopefully it stays stable. Now, tinfoil hats are going to start to argue that the stream issues right now are caused based on the topic I'm talking about. Okay, it says viewers will experience buffering, but yeah, like bitrate seems to be okay right now again. So if you show up for the shareholder meeting because you bought your share, it doesn't matter if it's eToro, Interactive Broker, Fidelity, wherever, they might say, sorry, you're not allowed to enter because there's no record of you owning a share, because again, that record only exists in the database of your broker. And then for the broker, there's only an entry at the database of the DTCC, or DTCC or DTC, and in the actual registry, there's only a big entry that says, okay, the DTCC or CEDA & Co. actually hold whatever 99% of all shares. Yeah. Now every company has a transfer agent that is a company like, for example, ComputerShare. ComputerShare is the transfer agent for a lot of things, GameStop, AMC, and a lot of other stocks, yeah, or companies out there. And basically, you can request the withdrawal of your shares from your broker, which then will be directly registered with the transfer agent, which then means it's not a complicated process. It just takes a little bit of time and potentially costs a small fee, because then you get a letter to confirm your address and you have to fill out a tax form and so on. And then you have an account with ComputerShare where you then basically hold the stock, and in the actual register, there is then mentioned, okay, you with your name, the shares that you hold, they cannot be lent out to short sellers anymore because they are locked away. And they are literally really in your name, which means if there would ever be the case, if like, for example, that's the goal of the, in quotes, let's GameStop movement, however you want to call it, the people that invest in GameStop, would be the theory, okay, that if they directly register 100% of the shares, then there should be no shares to trade anymore, which would be irrefutable proof that there is manipulation going on, so that there is like stream quality dropping again. So might actually have internet issues and have to redo that episode. Stream health. So yeah, no data. So bitrate's up again, still showing some red, but I'm gonna check actually the where do we have the stats? Okay, we have a lot of missed drop frames, so like if it keeps going like that, we call it a day. And I mean, anyway, 8 minutes left on today, and I will cover the same topic tomorrow again. So but yeah, so in theory, if 100% of shares are directly registered, then there could be no trade possible on an exchange, because CEDA and Co. would have no more shares, which means no broker could buy shares or could even hold shares. So if 100% of shares are registered, but your broker still has a database entries that says you own 100 shares, well, then it would be irrefutable proof that all you own is technically like a piece of paper and like basically a synthetic share. So, and synthetic shares or additional shares get created by short selling, because the way short selling works is if this is my share and I bought it and I own it, but I have it at, I don't know, Fidelity, Interactive Broker, or any other broker that on the other side of their business lends out shares for short selling. So I have this share again, but it's only a database entry at whatever my broker. And now there's somebody that wants to short GameStop or whichever share that is. So they borrow that share from me in theory and they sell it, which makes suddenly 2 shares. I don't have a second piece of paper right now, but which suddenly makes 2 shares appear on the market, because I still own this share, but on the database or like in the system, but that same share got sold to you, for example, because somebody borrowed it from me. And when they close their short position, they have to buy it back, so they can give it back to me. You can just talk, sweetie. What's that? Sorry. Thank you. Best wife ever, bringing paper to make the better comparison. So again, I have a share, but it's basically just an entry in some database, and then somebody shows up and tells my broker, hey, I'm going to pay you 20% per day in interest if you borrow me that share, so I can short it, which means, well, in the database, I still have the share, but technically there's suddenly a second share that the short seller gets and that he sells to somebody else, which suddenly makes it appear like there are 2 shares. And when the short seller closes the position, they have to buy back that share to give it back to me. But in theory, there are in the meantime still 2 shares, because my brokerage account still shows that I own 1 share of whatever stock it is. Now, the funny thing is, or the problem is, now you bought that second share from the guy that sold short, but then another guy wants to sell short, and he suddenly borrows the share from you, which then suddenly creates 3 shares out of my 1 original share. And now again, if 100% of the stock would be directly registered, that means there is not a single real share out there in the market that could be bought, traded, borrowed, whatever, which means then every kind of share you think you have in your broker account, like it doesn't matter if it's, again, eToro, Interactive Broker, whatever, would actually instantly be proven to be a synthetic share, a fake share, which happens by so-called naked shorting, which is illegal with exceptions for market makers, which is completely ridiculous and bonkers, but And naked shorting, so usually for shorting, I would have to borrow that share from you, then I can sell it. And when I want to close my position, I buy it back and give it back to you. Naked shorting, however, which is illegal in most cases, but market makers have exceptions that allow them to do that, mostly to create liquidity, which is a fancy word for saying to actually prevent real price discovery, because they can naked short, which means they sell shares, or 1 share, 10 shares, a million shares, without actually borrowing them first, which means they just sell fake shares. Like if you throw on your printer and you print 1 million, I don't know, Disney shares, and you just sell them, although they are not real Disney shares, but because you're a market maker, you can do it. Now, the justification behind of it is completely bonkers, as I said, because it's about or the exceptions that are allowed to. people that are for short selling are like, okay, it helps with market discovery. If a company is overvalued and enough investors think it's overvalued, then will be enough investors that short sell it, which means then that the value will correct down to a healthy value. Yeah, like, I mean, that one, maybe not, but to be fair, if a company is overvalued, then enough investors would take profit. You don't need short sellers for that. So eventually enough investors would sell their shares to take profit, and the price would also correct. Yeah. Now, the second thing, which is really complete bonkers, is liquidity. So if I'm a market maker, which means I'm facilitating all the trades and blah, 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 and now there is no trading volume because nobody wants to sell GameStop shares right now, but people want to buy it, but I don't have any to give them to, so I cannot fulfill their orders, which technically would mean I would tell those people, sorry, your order couldn't be filled. And then people would start to offer more money because they want to have the share. They try to buy it for, I don't know, like $20. They don't get a share. They offer 25. They don't get a share. And if they eventually offer enough, well, then somebody will say, oh, for that price, you can have my share. Yeah. And that would be fair price discovery in a fair market, because it would mean supply and demand. If nobody wants to sell, but people want to buy, the price goes up. However, market makers need exceptions for where naked shorting is not illegal, and that would be one of those in some way, where basically you want to and sells them anyway, and then you get your share for $20 when in fact nobody really wanted to sell it to you for $20, and the price, instead of going up, might even go down because or not might, but actually will go down because it dilutes the markets. Yeah, so there are suddenly more shares than there should be. So like if we $100, if I have 100 books, yeah, bad example with the book. Okay, let's if we have 100 apples and let's try to come up with a better example how to explain that dilution better. Market capitalization. Yeah. So let's say we have I don't know, a pool of money, a pool of gold, whatever it is, yeah, with $1 million in it, and there's like certificates that you can have, and if you own a certificate, you own a share of it. So if one person has a certificate, he owns the entire 1 million. If 10 person have a certificate, each person's certificate is worth 100,000. If 100 people have a certificate, each certificate is worth only 10,000. Yeah. Now, if I for liquidity purposes just print another 10,000 certificates so I can provide liquidity, well, then suddenly your certificate, instead of being worth 10,000, 100,000, whatever, also is suddenly only worth $10. Yeah, which then means instead of, if there would be a trading chart, instead of trading for 100,000 per certificate, it would suddenly trade at $10. Yeah? And yeah, that's pretty much the issue that with GameStop now. To finish this up, so in theory, again, if investors were to register exactly 100% of shares, with the transfer agent, then there would be not a single real share left on the market, proving that all other shares are basically synthetic shares that have to have been created through naked shorting of some way or the other. Yeah. Now, the problem, however, with that is, and that's like the tricky part, is the moment one person at the transfer agent then says, oh, I'm going to sell one share, that share would go back to see the NCO and again would be in circulation. And then that share, again, somebody would borrow that share for you, and we would have two shares, and then two people would borrow the same shares again, because there is another like rule, exception, whatever you want to call it, loophole, and that is that when it comes to short selling, there are situations where I don't have to borrow your share. I just have to locate it. So I just have to know if I needed to, I can borrow it. Yeah. So which means if I have this share, and again, 99.99% of shares are direct registered with the transfer agent, but one person sells one share that goes back then to see the NCO. And then that one share is in someone's account, either see the NCO or then some broker says, okay, that's my share. And then as for short selling, then the point is, well, I don't have to borrow it. I see, oh, there's one share, which means I can sell one share short. And the next guy also, oh, there's one share, so I'm going to sell that one share short. So you can theoretically, just by locating one share, create infinite shorts because you fulfill the requirement, well, that in theory I could borrow that share, but that at the same time 100 other people or 1,000 other people would need to borrow that share. Yeah, that's not checked and not validated. Yeah. So the problem with the whole GameStop theory, therefore, is, I mean, not problem with the theory. The issue is that I think it's called prisoner's dilemma. So once 100% of shares will be registered, the price should naturally shoot up because there will be no way to buy unless you offer enough money. So there will then be pending market, or not market orders, but pending orders, where if the price is $20, where people say, okay, I'm going to list my shares for sale for $200, for $500, short sellers will be forced to buy at those prices, so it will create some kind of short squeeze. But the moment a certain percentage of shares then get sold out from computer shares to CEDA and CO, well, then the short sellers again can create their shorts, whatever. So it's going to be interesting to see how that plays out, because again, the moment somebody sells or multiple people sell hundreds of thousands of shares are back in circulation, which then again can be used to say, we pinpoint or locate that share, or 10 people locate the same share and sell it short to then drive the price back down. Yeah. Either way, anyway, to finish that whole GameStop thing up, so the whole short squeeze theory, whatever you want to call it, is great. It's really great, and I made a decent profit of it in 2021. I didn't sell, but still made a profit compared to when I bought in. So even at the current price of GameStop. But and I'm confident we will see something interesting once the retail investor base or household investors of GameStop actually manage to lock up the 100%. What we will see happening, if it will be really the mother of all short squeezes, no idea, to be honest, because again, as soon as somebody starts selling, we might be back in the same issue that short sellers can just infinitely create shares to push down the price again. But besides that, GameStop is also one of the few companies that completed a complete turnaround from basically being being short at more than 100% because, they're going to be bankrupt next year. I mean, it was COVID, and it's a brick and mortar business, blah, 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 to actually this year, after that turnaround, finally posting profits again, having more than $1 billion in cash on hands and a lot of other things that speak for the company and for future profits as well. So GameStop's position is something that I definitely will hold. I may or may not at some point move more of my shares into my computer share account. I really haven't decided that yet, because the moment I sell them and move them, I also basically have a new 12-month period running in terms of if I eventually sell them, taxes on profit, lower or higher or none at all. And I also get the point that if 100% of shares gets locked up and I still hold shares in eToro, those shares are basically then not worthless, but they become like proof that a crime has been committed. But on the other hand, if that were the case, I'm also confident that with enough, with the proper legal insurance and so on, I will still be entitled to get the shares value sued from my broker. Anyway, that's it for today. And despite that, so that doesn't mean that I'm against direct registration. Again, I also have a portion of my shares directly registered with the transfer agent, and I definitely, and I don't recommend you make your own decisions, but I think it makes sense to do so. I'm just saying that I also don't mind having still a few shares at my broker, because once we reach 100%, or if we reach 100% in directly registered shares, my shares, if they still show up in my eToro portfolio, again, provide proof that there has been a crime committed in terms of selling fake shares, basically. But anyway, that's it for today. I will rewatch or skip through the recording of this live stream, and if it's been too droppy in between, we will remove this episode and repeat it tomorrow. Otherwise, tomorrow we will look at some new stock that we may or may not invest in. And that's it. So thank you all for tuning in. See you all hopefully tomorrow with another episode, and that's it.